Hi, thanks for having me. Because we're here talking about the Great Barrier Reef, I thought I'd start with this. That's a Ferrari 250 GTO. 36 of those were made between 1962 and 1964. And when it was released for sale, it retailed for the grand total price of 8,000 Australian pounds, had you been able to buy one then. The intrinsic value, I guess, of the car is a little bit less than that. If you take the 880 kilograms of mild steel and the 130 litres of fuel in the fuel tank and the 4 tyres, probably comes somewhere between 1,000 and 2,000 pounds of real value, plus some IP from Ferrari. And last month, an investor paid $94 million for that car. Not that one on the screen, it was a grey one, but that's a nice photo. There's 36 of those made. They're all still amazingly around. They were all raced and they're all still in reasonably good condition. And so the total value of those 36 cars now is $3.5 billion. So what about other assets? There's one. Valued last year at $56 billion across a range of criteria. And since that valuation was released, we've been able to mobilise this much money in conservation investments. So we're doing something wrong. If a car worth $2,000 can trade for $94 million, something worth $56 billion, we've been able to mobilise zero in private sector investments. Of course, there's some great work happening with reef credits and with Qantas future planning. You'll hear more about that in the finance session later. But still, investments at scale are not happening. And it's not just the reef that's facing these challenges, biodiversity loss globally. In order to address biodiversity decline globally, McKinsey, WWF and Credit Suisse estimate we need about $300 to $400 billion of new investment annually to address that decline. And there's about $50 billion available from governments and from philanthropy. A few billion dollars from philanthropy and about $40 to $50 billion in government spending from environment budgets domestically and their environment-focused aid budgets. So our choices to meet this challenge are to increase philanthropy by 6,000% or increase government funding by 600%. And I'll let you decide whether you think either of those is feasible. Bill and Melinda Gates Foundation is the largest private foundation endowed globally, $40 billion corpus. We're funding a range of things, including poverty. If they were to give $2 a day to the 2 billion people who live on $2 a day, the foundation would be out of business in 10 days. So we're not going to solve the world or save the reef by giving money away. So the scale of the problem is obviously enormous. But the scale of the solution absolutely dwarfs the scale of the problem. There are 280 trillion US dollars of investable assets globally. And that grows by about $11 trillion a year. So we can realise that $300 to $400 billion worth of conservation finance challenge, conservation investment challenge, by leaving 99.9% of the world's money where it is. And just redirecting 0.1% of it, or putting it another way, roughly 3% of the growth in global wealth annually, without even touching the corpus. So the solutions are there. And that's how we think about 100x giving, 100x philanthropy, or 100x investing. We will never save the Great Barrier Reef, as I said, by giving money away. So how do we take $1 of philanthropy, or $1 million of philanthropy, and turn that into $100 billion of conservation finance, or $100 billion of conservation finance? And there's an intermediate step, which is a really important role there, of government funding, public financing to solve conservation challenges. I've put taxes there, because as one of my more cynical board members reminded me the other day, they said the government can't give you anything they haven't already taken from you. And so it's about reinvesting our taxes back into conservation. And I'll give some examples about how that is happening in the world now, in real examples where we're mobilising this finance at scale and have the opportunity to do so here in Queensland. One of the key messages is the tools that you need to do this already exist. And we've learned over a number of years of doing conservation finance that the best way to get to scale is to generate returns in the real economy using markets for commodities that already exist in a large and sophisticated way globally. So you can already own, trade and invest in all of the things that many of the things that we care about as conservationists. And the sort of irony is that many of these things are not only conservation outcomes, they're conservation threats, or vice versa. Take the global food system. Conserving the global food system, food security for 7 to 9 billion people is obviously a key conservation objective, but the development of agriculture is obviously a massively key threatening process. But there already exist large and sophisticated markets for carbon, for agriculture, hectares of farmland, forestry. You can invest in hectares of forestry, fisheries, joules and kilowatt hours of energy, gigalitres of water. All of these things are readily investable and tradable now. We have this amazing advantage in the conservation movement that we're not taking advantage of, in that we can invest in these things. If we work in the social sector or health or mental health, in order to unlock the value of the economic value of improvements in mental health, for example, or social welfare, you have to come up with some complex policy instrument by which savings are realised and there's a counterparty and you create a social impact bond or some other complicated instrument to make it investable. In conservation, you can already just buy the stuff and trade it, and just do so in a smarter, more sustainable and more positively impactful way. So a couple of examples. The Nature Conservancy has a goal to raise $1 billion of conservation finance by 2020, and as at mid-2018, we're at $2.2 billion. And so we've already well exceeded our goal for 2020, but we're only just getting started. We're at this inflection point in conservation finance where, as you know, innovation is not linear. So we're at a tipping point where we're just about to unlock really massive scale in conservation. And of those deals up there, the most recent is close to $2 billion on its own. And so we are really starting to start to see the scale that we need. Some quick examples. I won't spend a lot of time on this slide, but debt for nature swaps, some of you may be aware of, where first world creditors forgive or reduce the debt or refinance the debt of developing world economies in return for nature conservation. Water funds, Australia is blessed with the largest and most sophisticated water market globally, at least a $10 billion market, probably closer to a $20 to $30 billion market depending on what you count. The next biggest water market globally is a tenth the size. Energy, obviously, you're very aware of, agriculture and fisheries, all of these things exist. PNC owns a livestock trading business in Kenya, where we work with Samburu herders to improve their not only pasture quality, but to negotiate better on their behalf at the market so that they can graze fewer cattle and be paid the same money. So all these things are pretty straightforward if you do a couple of things right, and I'll talk about what they are later. So just a couple of examples. Again, thinking about 100x. So the Murray-Darling Basin Balanced Water Fund is a fund operated by the Nature Conservancy in Kilter Rural in New South Wales and Victoria. It's growing to $100 million. It's currently at $50 million of invested capital, and that took around $600,000 of philanthropy to set up. Somebody had to pay the lawyers to work out how to set this fund up and do some economic modelling, do some accounting to get the fund to the start line. Now that it's at the start line, it's 100% commercial. This year, the fund returned 33% return to its investors and outperformed other water funds in the market while restoring 4 wetland systems in New South Wales and Victoria at the same time. So this stuff can work. Really simple model. The fund buys water entitlements on the market from willing sellers and then allocates those allocations on the water on a counter-cyclical basis. When water is scarce and expensive, we allocate the bulk of the portfolio to agriculture. When water is cheap and abundant, we're able to allocate more of the portfolio to wetlands. That sounds counterintuitive, and it is, and what it does is it replicates the natural wetting and drying rhythms of the Murray-Darling Basin. Wetlands in the basin have evolved to dry out, not to the extent that they do now, but largely. They haven't evolved to miss floods. So last year we delivered, in one project, we delivered 1 gigalitre of water to a wetland in New South Wales at a grand total opportunity cost to the fund of $30,000 out of $30 odd million then of capital invested. So again, 99.9% of the fund's returns were unaffected by being able to have this conservation impact. In Africa, you're obviously familiar with renewables deals, they're pretty straightforward. This one though is different in that it's used, the returns are used to finance conservation at the Lewa Conservancy and smooth out the bumpy revenues of the park managers from tourism and from government grants. Really exciting one, partnership with TNC and Swiss Re, and Vicky Mullen from Swiss Re is here today. The world's first insurance product for a coral reef. In Mexico at Cancun, 60 kilometres of the Mesoamerican reef has been insured against hurricane damage. In the middle you can see there it's a parametric cat in the box, and I know you all know what that means. It's a parametric policy, and that means rather than paying out on damages assessed, it pays out on certain conditions being met. Wind speed, wave height, category rating of the cyclone, whatever the agreed trigger is, the policy immediately pays out once that trigger is met. And that means you don't have to have insurance assessors running around and taking forever to make a claim and arguing over how much damage was caused. The event happened or it didn't, and it pays out, and it pays out to the reef. For every metre of reef that is lost at Cancun, 3 metres of beach is lost. And so the buyers of the policy here are the hoteliers onshore who need to get restoration happening in the water as quickly as possible, not only to ensure that, that the reef is restored, but to ensure that they have a product that they can sell to visitors. We think this is replicable in Australia, and Vicky and I will be talking to a few folks today about how to do that in the GBR. The key question here is, what is the threat and where is the box? Cyclone is the easiest threat to insure against in the first instance. The insurance industry is used to insuring against sudden shocks. So that's the low-hanging fruit. But what else could we insure against? Could we insure against more of those slow-moving threats, those chronic stresses, hot water, nutrients, for example? How do we insure against those? It's definitely doable here in the Great Barrier Reef, and we're looking forward to getting further into that. But we also have opportunities to deal with land-based threats. Cows and sugar, as you know, contribute a lot of sediment nutrient into the reef, and there's a really, well, we think, fairly straightforward way to deal with that using financial markets. We don't necessarily have to spend money doing gully repair on individual farms, going and paying people to do stuff on their farms. We don't think is the way to go. And many of the behavioural change incentive things have very, very low take-up. So the proposed model that we think is the more straightforward way to do it is just go and buy the farms or buy the businesses or directly invest in agricultural transformation to get a return at the farm gate. If you get a return at the farm gate through improved practice, then you can mobilise capital at scale. So using 100x, take $1 million of grants to do the walking around, to design the fund, do the due diligence, set up an information memorandum, raise the money, $100 million in payments to incentivise transformation within the fund, because the challenge in the fund is just those marginal extra costs across the whole portfolio of properties just make it a little bit unviable to invest in at scale. But if you can use $100 million to slightly boost the returns in the fund rather than doing individual gullies, for example, then you can mobilise, we think, at least $1 billion of private sector investment in agricultural transformation in the reef catchments. So a couple of mantras around how to think about mobilising finance. If you don't know who's going to pay, if you don't have a way to pay, for someone to pay, then it doesn't matter if the reef is valued at $56 billion, it might as well be valued at zero. Without someone to pay, you don't have a product. So work out who it is the direct economic beneficiary of the work that you're trying to do, and then work back from that. How do you unlock that economic value and motivate somebody to invest? Without that, you're nowhere. Secondly, use existing markets. As I said, there are trillions of dollars worth of markets for the things that we're interested in. Energy, water, climate, agriculture, all of those things. Tap into those existing markets. Market development is really important. The carbon market is a great example of that, but that's taken decades. Time is against us and scale is against us. So yes, if you want to invest in new markets for environmental commodities, please do so, but if you want to get things done at scale, use existing markets. And finally, one of the big things that we've learned over the last couple of years raising money for conservation finance is don't think big and start small, think big and start big. Weirdly, it is much easier to raise $1 billion than it is to raise 100 million. And that's because investment funds like the Australian superannuation funds are so big now, and the Canadian pension funds are bigger. BlackRock in the US has $6.3 trillion worth of funds under management. And they often have minimum investment thresholds and maximum investment concentrations. So take Australian Super, $130 billion under management, won't invest anything less than about $200 million, and doesn't often want to have a concentration of more than about 25% in any fund. So automatically you need an investment vehicle that's worth $800 million before they will even look at it. And that was one of the things we learned about setting up a water fund. We thought, oh, we'll do a pilot, we'll start with 25 million. We got to 27 million in capital raising and we decided to close the fund. Man, was that a mistake. Because when people are offering you money, you should take it. And so we got to 27 million. It's taken us the next 3 years, stuck on 27 million, to finally get to 50 million. It'd be a lot faster to get to 100. But when you're trying to raise money for this stuff, you have to think big because the investors are thinking big. That's me. Thank you.
Fantastic, thank you, Rich. Time for questions? Are they all stunned? Serious? Was there one somewhere? Oh, yes.
Sorry, thanks, Rich. Thank you.
Vicky Mullen from Swiss Re. I'm going to ask you about insurance. The question is, how sophisticated are the asset managers here in Australia around this concept of investing in natural assets?
That is a very good question. One of the reasons I have a self-managed super fund is because of the conversations I've had with asset managers. So you've got asset managers and asset allocation advisors who work on behalf of the big superannuation funds, and as the guy from one of the asset managers said to me, you can be different or you can be wrong, but you can't be different and wrong. And so we all invest in the same things at the same time at the same scale. But once you get one asset manager in this case, in the super fund we've just got, and the water fund we've just got our first profit to members super fund in the water fund, which is really fantastic for mainstreaming conservation investments because they have the same sole purpose test as every other super fund. A super fund is only allowed to invest in returns for its members. The great thing about super funds and their sheepish behaviour, or sheep-like behaviour, is that as soon as you get one in, particularly if they're seen as a peer by others in the sector, then you start to get a flood of them in. So it only takes a couple of those peers to get in and they all start to come in, but they are coming from a very low base of understanding.
Any other questions? Any other back? He has a bit more.
Firstly, don't run off, I want to give you my card. So we often look at the other side of the equation in relation to major investments, which is around corporate social responsibility type of stuff. I mean, you're talking more about the impact investing side, I think, in relation to how you would generate the funds to support things like the reef. Is the corporate social responsibility stuff just sort of in the weeds and not really worth chasing after as compared to what you're suggesting here?
If you're talking about corporate philanthropy, corporate giving, yes, you're in the weeds, and that's just this is not going to do it. If you're talking about corporate practice change, and Frank from Mars Corporation here is a great example. That's not in the weeds. That really is powerful stuff, and we need to invest more in that. You know, they're talking about how you grow, you know, twice the productive cocoa and half the land. If we can really mobilise that at scale with the way that delivers returns to shareholders through practice change, absolutely, that's one of the biggest tools in the toolbox. But corporate social responsibility and, you know, corporate giving isn't going to get us there. I had a slide up here and I took it out for time. Dow, for example, has the Dow Nature Goal. It's a partnership with the Nature Conservancy, and by 2025 they have a goal to realise $1 billion worth of measurable shareholder value on the balance sheet through investments in nature. And the way they do that, for example, is in Texas, they've built a wetland instead of a mechanised treatment plant for water quality. Millions of dollars cheaper to build and millions of dollars cheaper to run. The difference between the capital cost and the expected maintenance cost over time is a couple of $100 million which sits on the balance sheet. So those things really are investable at scale, and that's the way to do it. Work on practice change and real economic returns rather than corporate benefaction.
We might think that. I'm sure we're going to be. Thank you.
Thanks.